today I'm going to be looking at how do we define hotel capital markets, looking at what's actually going on in the current economy with hotels, and we've seen a lot of volatility in that recently. We're going to look at the key drivers of how do we value hotels and what are the key performance indicators that, or what we sometimes call KPIs, what are they in the hotel sector, because it varies a lot compared to other classical forms of commercial real estate. We'll look a little bit about the management structure of hotels, and then we'll also finalize on the STR chain scale. So let's have a look at this. So if I click this. So when we look at the hotel capital markets, there's a wide range of investors that are looking to invest in hotels. One of the largest investors we could view is private equity, and they're looking to go into the hotel market, invest a significant sum, and generally speaking, they're looking to turn around and exit that hotel after a period of time. So we saw quite a large sum of investment over the COVID-19 pandemic from private equity into the hotel market space, because valuations over the COVID-19 pandemic plummeted for this sector. That was because, of course, hotels were closed because of the pandemic. So we had no rental income coming in. And so people were concerned that, are we ever going to see a return of hotels? And as we've seen over the pandemic, we've now beginning to see larger changes in terms of how we work. So will we see as much demand from business travelers going to hotels when we can do meetings online like we're doing right now through Zoom? So maybe the demand from the business side may fall. Now, over the pandemic, there was a large collapse in prices in the hotel sector, but we saw quite a strong rebound after, because a lot of households was saving a significant amount of money over that period. And so we saw that there's been this bonus kind of demand from households, and a lot of people going on holiday after them government restrictions were lifted. However, that's not uniform across the whole world, because of course we have China with their zero COVID policy. And so there's different places that are benefiting from the opening up of the COVID-19 pandemic, but there's certainly a lot of places that are still struggling, especially in the Eastern markets. So private equity is a big investor. And like I say, they're looking to go into a hotel investment, turn it around, and then exit anywhere between 3 and 7 years, generally speaking. And I believe we also have a webinar on private equity as well. There's also high net wealth individuals, so either family offices or just individuals who will look to invest in hotels, and maybe under different management structures, and they may look to, again, invest for, generally speaking, a longer term than private equity, and to generate significant returns. We may see overseas corporate or institutional investors, and they're looking, again, to, generally speaking, diversify their income from hotel revenue sources. So what might happen there is they want to generate money, but because hotels are an alternative asset class, it will fit in well with their portfolio. However, like we see, hotels have some of the biggest volatility in rents based on customer demand. So really, we're looking at people who are risk-taking compared to risk-averse investors. Generally speaking, corporate investors or institutional investors who are risk-averse are going to be probably looking towards either office space, which has gone down in value recently, or the big winner over the pandemic was the residential market. So if you're more risk averse, they'll be going towards that rather than the hotel space. We also see that there's UK institutional investors and overseas investors from other hotel firms that may want to diversify their range as well. So there's a wide source of people looking to invest in hotels, and you can see from the table below just some examples of the different types of investors which relate to the points I made above. And you can see that each one has kind of different budgets, and these vary depending on each investor. And we can generally quantify the investment by how much they're paying per room in a hotel. So we can see, for example, the Qatar Investment Authority spending over £1 million per room, compared to maybe some of the high net wealth family offices like Vivian only spending 153,000. So that, of course, depends on the budget of the different types of investors. So if we look at the capital markets, as I said before, the COVID-19 pandemic had a big impact on the hotel sector, but we are seeing sustained growth now. The only issue that we're beginning to see is, of course, we're in the middle of a cost of living crisis. So with business demand returning back to relatively normal levels, but with the credit crisis going on in terms of, cost of living crisis, will we see people be willing to go on hotel breaks? We might not. We saw large demand in the UK of people staying within the UK and not going overseas, and places like Spain and Portugal suffered quite a lot with that. But we're waiting to see the long-term effects. No one really knows at the moment. So we think about hotels, but let's have a look at how do we invest in hotels. So there's two ways that you can think of a hotel. They're very different than our regular commercial real estate. So if we take offices as an investment, what we would often do is calculate the net internal area of the floor space. We would then multiply that by the rent per square foot, and therefore you would get your revenue that you would generate from rent on either a monthly or annual basis, depending on how you calculated it. Now, with a hotel, it's very different because you're not really renting it just on floor space, you're doing it based on rooms. And so the operation of a hotel has a significant impact. When you buy an office space, or once you've renovated it and rented it, there's not much else you need to do other than the maintenance of the building, or if you go into serviced office space, there might be a little bit more involved. But running a hotel is also not just a piece of real estate, it's running a business. You're bringing people into this sector. It's more of a guest experience. And then what you want to do is rent rooms to them, but also monetize that guest experience. Can we upsell and do cross-selling when guests arrive at the hotel to, for example, make them come to the restaurant, drink in the bar, use the spa facilities, and can we generate additional income from this? That's one of the key drivers in terms of hotel operations, is maximizing that guest experience so that guests will come back and generating that additional revenue income. Now, different hotels will focus on different levels of amenities when guests come in. Some won't provide restaurants or spas, and they only focus on the rooms. And that's fine. And we'll see that in the STR chain scale of where they will be generally allocated into. But for the higher and more luxury rated hotels, we would expect to see significant revenue from the guest experience, sometimes even more than the hotel rooms themselves. Now, in terms of our operational income, we are being affected by tourism flow and business income. So how many business guests are coming into the hotel. So you'll often see hotels near either key travel locations for holidays or in city centres where business guests need to be close to the central business district so they can get to their meetings. Now, that has an effect on the valuation, and what we want to see is that hotels maximize their operational income. But like any other piece of commercial real estate, it sits on a plot of land which has residual value. The walls themselves have value in the building. So there is value within the hotel structure itself. And we view that as a stable asset because the hotel isn't really going to be moving anywhere, and we can collateralize and borrow against that to fund further expansion. The issue with hotels is often to make them attractive to people to come to. We often view them as somewhat lumpy and localized. And what we mean by that is they're generally in unique buildings, and that you're not going to find one on every street. They're in certain areas. And so depending on the budget of the hotel and the experience they're trying to provide, the location will significantly depend on that. So if we look at the key drivers, there is 4 key drivers that we mainly think about if you're going into a regular valuation meeting about hotels, and they would be the occupancy rate, the average daily rate, also known as the ADR, the revenue per available room, and the gross operating profit, or the GOP. Now, if we think of the occupancy rate, this one would probably be known by most of you, but it's how many rooms have we allocated, and often we'll quote that on an annualized basis. If you're looking to calculate a value on a hotel, you would generally use an annualized occupancy rate compared to maybe a daily occupancy rate. Now, remember, occupancy rates are going to vary across seasons in different months, and of course, weekend occupancy will generally be higher than midweek. And different hotels prioritize how they maximize their occupancy. There's a variety of different ways, including pricing structures, doing discounts, and trying to build loyalty through loyalty points to bring back customers to that hotel. And that will increase occupancy rates. So what we want to see is that occupancy rates over time increase, and that we can see that over maybe, say, a 5-year period, that there's a significant trend in the increase. Now, of course, occupancy is dependent on the economy. So if the economy is going down, like we might be seeing at the moment, and we're entering a recession, occupancy rates may also go down. So there is some co-integration between the economy and the occupancy rate. Another key factor that we talk about in terms of hotels is the ADR, or the average daily rate. Now, to calculate this, we generally look at the revenue generated from each room divided by the number of rooms that are rented. So what we want to do is maximize the average daily rate. Now, one of the ways we could maximize that is either charging more money on each room, or we could look at maybe trying to upsell when they get to the room, so provide them breakfast, or try and generate sales from the minibar. ADR is quite an important one, maybe more so than occupancy rate, because it's telling us how well is the current rental doing on them rooms. However, a key issue with the average daily rate is it doesn't look at the occupancy rate. So we may have a high average daily rate, so we're generating a lot of money from each room rented, but it's not giving us any indication on how occupied they are. And therefore, that's why the most important driver in terms of hotel operations is the revenue per available room. So also known as RevPAR, this is our average daily rate times by the occupancy rate. There's a few different ways that you can calculate it, but that's the most simple way of doing it. Now, what we want to see with the revenue per available room is, again, that it increases over time, and investors often use the RevPAR as an indicator of the health of a hotel. Now, one of the ways that you could look at how does your revenue per available room compare to others is there will often be indexes created in that local area, and you can look and compare your hotel to your competitors in the same region. That means you can see how are we doing as a hotel compared to them. So if we got a lower RevPAR, we need to think about why is that? What's driving that? Is it occupancy, or maybe is it our ADR? How do we look at changing that to increase the revenue per available room? It'll often form a strong part of the valuation in terms of a hotel. Now, we may see that the RevPAR is often lower than the average daily rate because we're now taking into account that occupancy rate, which is very rarely 100%. But of course, we want that to be 100%. One of the final key drivers is, of course, we're not been looking at profitability. So looking at the gross operating profit or the net operating profit, i.e. our income after expenses and taxes, if you're looking at net, is a final good measure of the profitability of a hotel. We can have a good RevPAR and ADR, but that doesn't really matter if we're not generating any profitability. So they're the key drivers. And in this kind of text box, this diagram here, you can see some of the other factors or key performance indicators that we may use. But then for what I would say the most important ones to know. So let's have a look at the management structure of hotels. So there's a variety of management structures that people can use, but most people generally think of probably a franchised hotel. That's what we generally know and go to. However, there's more than what we think, and there's 4 to be exact. So if we start with privately owned and operated hotels, these are generally going to be based on a consortium of investors who are looking to invest in a private hotel, or it could be some high net wealth individuals who are looking to take on that hotel and hopefully boost revenue and maybe exit in the future. Now, by taking on a hotel privately, you are allowed to make your own management decisions. So you can take the direction of the hotel in any way that you want because you're your own boss. So there's a good pro to that, and some people enjoy that. However, you often find that they will have lower occupancy rates compared to franchised hotels. Because when people are going to a hotel, if you go to, say, a franchised hotel like a Hilton or a Premier Inn, you know, generally speaking, the quality of that hotel before you've even gone there. But with a private hotel, you don't know. And so some people don't trust that. They like what they know, and that's why they wouldn't go to privately owned hotels. The other issue that you might have with privately owned hotels is you're going to have to pay for your own marketing. There's no clear strategy on how you boost occupancy rates and the ADR even through marketing. So you're going to have to organize that yourself, maybe hire a team to do that, and you're going to have to pay money as well to do that. The other thing that you also won't benefit from is any discounts. When you're dealing with a franchised organization, they may be able to provide you beds, linen, so on and so forth at a discounted rate because they're buying on such a large volume. Where if you're just a high net wealth individual with one or two hotels, you're not going to be able to get the same discounts. So there is some limitations there, but of course, the key thing is you get to run your own hotel and make your own decisions and build a brand yourself. So some people like that model. The next model is a managed hotel. So managed hotels is where a management company will come in and take over the management decisions for you. Now, this is a good way for you to retain ownership of a hotel and good if you have very little experience. You're going to let someone come in and make all them decisions for you and hopefully generate profit. You'll generally be required to do the maintenance on the hotel and maybe some other bits depending on the contract you make with the management company. But this is a good route if you don't want to take the risk of privately owning and running your own hotel. The next one that we may look at is the franchised hotel, which is the largest sector of hotels, especially in the US. About 70% of US hotels work in the franchise sector. Now, generally speaking, if you work in a franchise, it runs similar to, say, McDonald's, where we're going to pay a fee to the franchisor to use their logo and to incorporate their management protocols. Now, as I said before, you generally speaking will have higher occupancy rates compared to, say, privately owned and operated hotels because you're getting their experience, you're taking on that brand, and customers already trust that. Now, one of the issues with doing a franchise hotel is that if the brand that you've took on fails or is going worse, then of course it's going to look worse for you and you might end up with lower occupancy, lower ADR. So you are tied in with that brand. The other thing that can be quite costly is brands will often stipulate, how do you decorate a room? How does the floor plan look? So often investors may look at property improvement plans because if you have a large hotel, say 300 rooms, and you're changing a bathroom in every room, it's going to be very costly to do that. And so they will dictate even to the degree of what type of lights that you use in the room. And so if you don't have the money to do that, it could end up causing issues between you and the franchisor. Now, the other benefit of going through a franchised organization is that you are going to benefit from them cost synergies, where you're going to be able to take advantage of the advertising that the franchisor will run. You'll also gain from the procurement of goods. So even though it's going to cost you a lot to meet the standards, you may get that at a discounted rate because they'll be able to purchase it in bulk goods. So there's pros and cons again, and depending on the fee, it might require some negotiation, and often you will need some experience before someone will take you on as a franchise management structure. The final management structure that we should be aware of is leased, and this is kind of, generally speaking, a hands-off approach. Essentially, you'll lease the building to the company who will basically make most of the management decisions. Now, in terms of a lease structure, the way that we can think about it is often you will lease the building to said company, and then you will either take two payment options. The first one would be a fixed rent, and you just take that on a monthly or quarterly basis, and that's it, you're done. Now, that's generally the lowest risk option. You know that you're always going to be paid, but some more risk-taking people may want to reduce that fixed rent and actually take a percentage of the profits. Now, of course, that's riskier because you're then intermingling their success with your success. And so there could be issues there. However, it could be highly lucrative where if you're just charging a fixed rent and the hotel becomes very profitable, you won't see any upside in that. Now, if you decide to take on the risk and get a percentage of the revenues, often they will still stipulate a minimum payment that needs to be paid to you. So that will often happen as well. So these are the four main management structures and how they work. And hopefully it gives you an idea with the examples on the slide as well of different types of management structures in hotels. So the final thing that we should be aware of is the STR chain scale, known as the Smith Travel Research chain scale. Now, hotel categories, hotels can be allocated into different groups on this chain scale. Now, the way it works is that we look at the average daily rate, and it's the average daily rate based on the previous year. So if you had a very strong average daily rate, you may be allocated to, say, upscale or upper upscale. And so once you're allocated into that, often it gives investors an indication of how well your hotel is running. Generally speaking, you should see higher profitability in the upscale hotel models. Again, though, you generally see higher risks because of higher costs, more staff to meet them requirements. So the STR chain scale is all based on this average daily rate. It's updated often annually based on the ADR in the previous period. We provided here some examples of hotels which fit into these STR chain scales. Now, if you decide to do a franchised option and you want to see on what type of revenue in ADR you may make, well, you could look at the different parts of the chain scale to see where do they sit, what would be my expectation on that ADR level. So hopefully you've got a new insight into hotel investments. If you have questions, I'm happy to take them, and thanks for listening.
Thank you, Robert. That was fantastic. Thank you for going into much detail into each slide. I really enjoyed it. So yes, we have now 10 minutes of Q&A. So if any of our attendees have a question, do please let us know, put it on the Q&A area. In the meantime, Robert, I have a couple. I just wondering how the benchmark of hotels. So you've been talking about the RPAR and all of that, and I was wondering how a benchmark is created. Do you think the benchmark is created per category as the STR, or the benchmarks are created for each of the locations where the hotels are? How does it work?
Yeah, it's a really good question. So when we think of benchmarks, you could think of either a local benchmark or a national benchmark. So what is the ADR, for example, in a local area? So what is the average? And then you can look at the percentiles of what do, say, the luxury hotels, what's their ADR, what's the lower. And so you often would do it on a local basis if you're investing in a hotel, because you want to know the local market dynamics. Now, of course, the index is going to be affected by demand, and that affects occupancy rates and affects your ADR, which leads through to the RevPAR. So local indexes would be a first one, and therefore you would look at averaging out the different factors, and it can be quite hard to get that information. That's one of the issues here. So you might need to look at the financial statements of that hotel and make some estimates there. Now, if you're investing, we say, within a country, like we mentioned before, there's international investors, you may be looking at, say, a countrywide index of what's the rough ADR in this country. So that might be a more macro level review, is when you look at the country level indexes. Now, indexes, there's so many you could build. So you could base it on the chain scale, you could base it on the star rating of a hotel. There's a variety of methods, but often you'll be averaging and kind of looking at all the different ones within the scale that you set, and then saying, where am I fitting into that percentile?
Right. Oh, thank you. And just out of interest as well, so would bed and breakfast and hostel be modeled the same way, or do they use the same key performance metrics, you know?
Yeah, so they would. It was a point that I missed, so I'm glad you asked it. When we talk about the STR chain scale, privately owned hotels generally don't feature in it. They have their own chain scale. So that's a key point that I actually missed. Now, they will still use the same, for example, key drivers. They still want to know their occupancy rate, ADR. Again, the issue is when you have public companies like REITs or large private real estate operating investment companies, they'll publish some of their data, so you'll be able to get that information. When you've got small businesses like Airbnbs, bed and breakfast, so on and so forth, it's very rare for them to publish that data, so it's hard to compare where you are. You'd have to use the indexes that we've just mentioned.
Okay, that's great. And oh, we have a question, I think. Let me just check. Can you see it?
Yeah, so I'll just read it one second. Do you have any thoughts on the future outlook for hotel assets in regional locations versus those in major cities? Post-COVID, the regional hotels had a quicker rebound due to less reliance on international travel. I agree, Mark. I definitely think that there is going to be differences. So the future, in terms of a future outlook, with interest rates rising, I think we're going to see hotel prices falling on the whole. Especially, there's a lot of zombie hotels who have just survived the pandemic, are saddled with debt at this point, and so they are basically just paying down debt. And now that we're going into a cost of living crisis, I think you're going to see quite a few of them going bust, if I'm honest. So I think that's going to be one effect that we see in the medium term. I think in the long term, hopefully hotels will bounce back. In terms of a regional and a major city aspect, I think you'll always see now that after the pandemic, there will be higher occupancy rates in the cities. It's all, I think, a factor at this point of what is their structure and debt profile. That's going to have such a big impact on them going forward. And so hopefully they can rebound, but it's a good question.
Right. Okay. So again, if you have more questions, please. I think. Oh yeah, Mark Leigh is to say thank you, Robert. Hi, Mark. By the way, I think he has attended some of our courses. I have a question regarding the length of the leases of hotels. So we always talk about the leases in commercial offices. So now, with the pandemic, they went the leases periods is smaller, and with retail they are changing it as well. Is that a thing in hotels as well? Is there like an average of length lease for, I guess, lease structure management?
Yeah, so there's going to be a minimum lease term, and generally speaking, people want long-term leases because it provides stability, and that if you're making improvements to the hotel, that you're actually going to benefit from them. I'm not sure on the average lease. I'd have to look into that if I'm honest, but from my understanding, it's around, I would say, 15 years. There's a lot of incentives to get people in to pay that rent. Of course, it depends on the structure of the building as well. So if it's franchise, generally you'll be going into a certain length of agreement with them. And there's an extensive vetting process. And generally speaking, investors who choose that option will want to stay with them, because if you leave, you're going to lose all the fees and the upgrades that you've made. And you're going to, of course, see that lower occupancy. So, yeah.
Good. And just talking about modeling the hotels. So I understand that hotels do the financial model, counting the rooms as a unit of operation instead of using a square footage or square meters. How does it work?
Yeah, so you can value them based on, it's like everything. You're going to have to aggregate all of the different income sources and model it very similar to other commercial real estate. The issue you have, I think, with modeling hotels is defining the risk, because, like I said, it's not like a regular office building where you know the rent every single year. The revenue's highly volatile, and so you may want to average that over time, account for inflation, and you're going to be looking at different growth factors. So instead of, say, population growth or employment growth, for example, for commercial office space. For hotels, you're going to have to look at how much disposable income, the number of flights, so on and so forth. So you need to look at the risk factors, and they're a lot harder to estimate, and that feeds into them valuations. So you aggregate that income, then you can model it going forward. I think that the hard bit is going through each one of the risks and how that's going to affect it in the future.